now.
Cool.
Yeah, so just
All
start.
right.
Cool. Yeah, so hi everyone. So we're this Finance Meets Thursday. We meet here every Tuesday. We have incredible guests every week. So this week we have my friend Omar Han is here today. So he's a great investor, syndicator. So he's the founder of Boardwalk Wealth, and so he's also a chartered financial analyst. He's got a lot of experience in finance, a lot of experience in commercial real estate. He's been investing in a few different markets like Phoenix, and I'm sure you're going to go over more details yourself, Omar. And how many units do you guys stand currently? I know you've done a lot of work as far as I'm sure like core GP and GP, etc. positions.
Yeah, sure.
Yeah, I'm not sure. Maybe.
No, I can go through it. Look, the Pirate Kids we operate primarily are Texas,
Sure.
Georgia, Florida, and South Dakota.
Okay.
So we are both acquiring, which is, take your usual asset, value add, opportunistic, distressed, you name it. We've done it. Class A, B, and C, it doesn't really matter. We've done all of them. And basically make it go through the trash, right? Sometimes it's a management play, sometimes it's a lot of times it's a capital play, and other times it's both management and capital play, right? And rinse, repeat, typically hold it for anywhere from like 2.5, 3 years and exit out. And lastly, basically, I also do developments, and that's that I only do with one partner of mine because development I feel is more of you need a lot more things that can go wrong basically. So I always feel there you need to do it. You need to be even more picky and choosy with your partners. So all over, we've done about more than 2,100, 2,200 units in the last, four-ish years or so, give or take. Maybe it's 5, right? I'm more like 4, right? And again, for us, basically the deal is we're opportunistic people. So opportunity is the bigger deal, right? We're not necessarily looking to just programmatically buy XYZ. If we get a couple of opportunities, we'll do 2-3 deals back to back. If we don't get an opportunity, we'll just sit on our hand and see what happens. So that's that in a nutshell. A lot of this is easy in theory, hard in practice, right? Easy in theory in the sense that you need to look at opportunistic deals and you need to know about deals. Hard in practice is because while no one component is very hard, doing them together, building teams, training those teams, then making sure those teams follow up on like 100 small little things and not very hard things, but doing all of them every day for years on end. That's the hard in practice part. Like each action or activity we do is very hard in isolation.
Right. Yeah, that makes a lot of sense. And so you guys, so that's 2,100 units, and I'm sure like it's partner co-GP.
No, we are the owner operator. I'm the owner operator basically.
Right.
I mean, I have other partners basically, but the whole shit from day one basically was that I'm the operator. I mean, and that's a bad word. I have a team, right? I'm very lucky to have a good team. So yeah, I have staff on payroll and other partners as well. But basically, we are the operator, start to end. We source the deals. We put the deals under contract, all that stuff, pre-close and then post-close, basically. The running of the operations, processing the distributions, making sure the accounting gets done. A lot of the non-sexy, non-real estate related, even back office stuff, that also our team internally does.
So how do you guys, like, let's say the past year, like we look at like a single year of running operations and with the challenges that you mentioned, like how do you guys, let's say how many deals you guys managed to do like in this time?
Last year about, so if I started last year in say October, so Blue Pines, Eastwood, Langley. So 6, 4, 5. I think it's 5 or 6, I think.
Sure, 5. That's a lot at this level. So like how do you manage, to your point, like you build?
Oh dude, I don't think that's a lot at this level. There are guys doing like 20, 30 deals in the same time. So you're always looking up, right? You're always looking at people who are better than you, who have done more than you, and at least in my case, I'm using them as a role model. Right. An example of, wow, this person's really good. How can I be like this person? And a lot of times I go talk to them and be like, hey, how did you do it?
Sure. But what is your way to be kind of operationally efficient in terms of within your team? Like you do hire for every single function. You hire for asset management, you hire for for
Look, man,
acquisitions and so
basically,
forth.
look, at the end of the day, I sign on the loans.
Mhm.
It's my name. So basically, most of the people at the end of the day, yeah, they're giving to the deal, but they're really giving the money to me, right? Because I have the relationship. So it's all, I always chuckle when people say, oh, I'm outsourcing the asset management. And I was like, well, then why are you doing this? Like, what are you bringing to the table? Right. So look, while I have a team and I have trained my team extensively, we have systems and processes and people in place. It is an ever evolving process, right? So we have a set of, like, say, standardized systems and processes. I've also trained my property managers and the property management company to be viewing things, at least what I feel is my way. I mean, they can do it for different people, different ways, and then continuously adding to people along the team. So we're hiring another financial analyst. Hopefully, we can bring him on in the next couple of days. But we're always adding the right people to the team. But it's developing a team, training a team, and then a lot of times basically compensating them directly. Because look, you have to understand, as a principal, I take a big risk that, look, if the business works, yeah, I can make a lot of money. But if it doesn't work, I'm SOL, basically, right? I mean, I have to go figure out where the money comes from. But you have to compensate your team, because a lot of times they're just not going to stick around, man. If you have a good team, you have competent people, you have to pay them top dollar. That's just the way it is. I wish it wasn't the case, because I could save a lot of money. But in reality, look, we want top dollar for our efforts, right? So other people also want top dollar for their efforts. But till you don't build a team, it's just not going to happen.
Mm-hmm. Okay, so I mean, today's topic now, just to get to that part, now still we do have like housing affordability crisis as a kind of general direction. We're doing like a more open Q&A, but like what are like some of like when we scheduled it with this topic, like what has changed since then? I would say like
I think everything has changed since then, man.
so, right, exactly. So what are your thoughts about? Because we had a brief discussion back then about housing affordability, and like, so what are your thoughts then versus now that you want to share with us, perhaps?
Well, then versus now is that rates have moved up by 250, 300 basis points. So while it always happens, in boom times, when money is aplenty, liquidity is aplenty, you can't find deals. And in bad times, when there's not a lot of money, everybody wants to exit, you have lots of deals but no money, basically, because everybody's skittish, right? So right now, what we're seeing is it's at least in the markets we're in, they're going through a bit of a transition. The smart, intelligent sellers that have to sell because the loan is coming to you, partnership issues, whatever it is, they're at the end of their life cycle. They are reading the tea leaves and they're trying to sell quickly if they have to sell. Now, if you don't have to sell, you're just punting this, right? If you've got term on your debt, or you could refinance, which is becoming very hard these days, you just do that, because all you're trying to do is buy time. But the smart ones that know that they're in a jam and they have to sell, they're selling quickly. But there's a lot of people in the market who are looking at prices they're looking at prices, always prices 3 months in the past. And they're like, well, if I could get that price. And you're like, well, things have kind of changed. You don't get that price. You would have gotten that price 3 months ago. So it's a bit of a balancing act, but I think the market is doing the filtration a lot of times. And the people that are stuck in the past, and they, things aren't working, their loans are coming due, and they're still stuck and they're making it an ego issue, they're going to be in a world of trouble, basically. Right? But people who haven't made it into an ego issue and realize, look, it's better to take a little bit of loss, or little bit, say, slightly lesser profits than max profits, but at least you get out of the deal, right? Yeah, those people are going to be, I think for the most part, they'll be fine.
So is your strategy to, like that letter strategy you mentioned, to kind of try to, whichever deals you are targeted for an exit, unless they're
we don't write, dude, I mean, look, we're buying these 150 unit deals. We don't write any letters. I've never written a letter in my whole life. I'm going to be honest with you. I'm sure it works.
Okay.
I've never written a letter. I don't understand. Like, if somebody ever writes me a letter, I'll probably not even read it and throw it into the junk.
No. I was just
for us, it's a business transaction, right? So for us, how do we get deals? We basically get deals because, number one, we pretty much know a good portion of the owners in the markets we're in, right? And the brokers know us. Because look, there's only in every market. I'll give you an example of Atlanta, right? Atlanta is really Cushman, CBRE, GREA, which is Brown. That's about it, really. Yeah, Berkadia, right? There's 4 brokers, man. That's it. Maybe, I mean, there's other brokers, but there's the big 4, right? They handle like 80 to 90% of the market volume. Like if you know them, you probably know all the owners because their deal flows are going through them. They are the conduit through which all the deals are going through. So all the stuff you hear about
Yeah.
off market, yeah, it doesn't really work this way, man.
Right. No, Omar, I get that. And we've heard like a lot of that from other operators. I was actually referring to, I meant the later exit strategy or later, are you looking to exit some of your deals in the current market that you're as soon as possible? Is that your strategy or?
No, we don't have to. If we don't have to sell, we don't sell. Like for instance, I just refinanced 2 deals. One deal I refinanced the second time in 3 years. And the other deal I just refinanced and returned close to 50% of investors' capital back to them. So if you don't have to sell it, we're not going to sell it into a down market, right? There's no need to sell it, basically. So if you don't sell it, you don't sell it.
Sure, makes sense. So now, what about, so for the mortgage affordability has obviously worsened significantly.
Yes.
Right now, so that's like a combination of prices and interest rates. Now, prices are not too high in every region, and interest rates are, high, obviously, everywhere. So how do you see like are you seeing some divergent effects of that in different markets you guys operate in, or like?
Pricing valuations have gone, valuation or pricing has gone down. Now, has it gone down 1-to-1? No, but it's a lagging effect, right? So like interest rates will go up, and because it's private markets, so there's always a hope that you'll find a greater fool, right? Somebody will come in, they either don't know the market, or it's a 1031 situation, or they're just going to do something stupid, right? So there's always that hope in private markets that you'll find a greater fool. But generally, yes, pricing has gone down tremendously. I mean, deals that you were buying at, say, low 4s are now at least mid-5s caps going in. We're not, and nobody's buying the story of, hey, you do this and you do that and you'll get to a 6% cap rate in the future, but you pay me the money right now, right? Yeah, that thing doesn't really exist anymore because your sources of financing have dried up. Bridge debt, best of luck getting bridge debt and then closing a deal, because the CLO market is completely dead right now. So if they can't sell their package of loans forward, how will they service you, right? And then basically, you can go the bank loan route, but the bank typically is partial recourse, right? Or full recourse. So a lot of people don't want to sign up for that. And I don't blame them. I wouldn't want to do it. So it's really agency right now that can guarantee you execution. The problem there is agency is lower leverage, right? 60, 65, 50, something like that. So your returns aren't going to pencil out. So that's why pricing is coming down, has to come down to make sure you can pencil out your returns.
Now, you mentioned the balance between kind of when you have great deals, there isn't that much capital, and when there is a lot of capital, there are fewer great deals, right? This kind of thing.
Yes, that is the golden rule of life, man.
Right. And so that's sort of natural operation of markets in a way, or natural operation of private markets, if you will.
Well, I think it's even public markets, right? Because a lot of times the things we really even want to buy in the public markets, they're never on sale during good times.
Yep. Yeah. And okay, agreed. So where do you think, so on the kind of spectrum between those values, like discussing, like where do you think do we stand right now? Do we stand at having already compressed kind of lack of capital and already an increased flow of deals, or are we kind of in the middle, or like where do you see the market right now?
First of all, if I knew exactly that answer, Stefan, I'd be really rich. You probably wouldn't even see me on this webinar. Number one, right? Number two, look, I think it depends on your opinion on how long you feel this regime is going to last. So if you, like I was talking to another sponsor, and his opinion is this is a secular upshift for the next 10 years. Which means if it's a secular upshift for the next 10 years in rates, then, I mean, you should wait 1 or 2 or 3 years before you buy, because it's constantly going up, the rates, right? In my opinion, and opinion of a lot of people, again, this is a hedged opinion. It's not based in science. It's just a feelings-based opinion, right? That rates go up basically till, say, end of next year, or even stabilize, right? They'll have 2 more rate hikes this month and next month, and they stabilize at a very high spot till the end of next year, maybe Q1 2024, before they start coming down. So if that's what your opinion is, which is the opinion of us and a lot of other buyers, right? Then this might be a good time to buy because nobody can time the bottom. So because this basically means you're going to have a bottom and you're possibly going to have a lift off from that bottom, right? So because nobody can time the bottom, if you find a good deal where you can find good financing and the numbers make sense in the markets you're already operating in, so you have a good knowledge about it, go for the deal. But this is based on the opinion that, say, 2024 comes around and rates start going down.
Right.
That's the opinion underlying.
Right. But if we kind of break that in two parts, let's say on the capital side, are you seeing like harder to get capital already or not yet?
For a lot of people it is harder to get capital. Look, we are closing a deal next week in Sandy Springs, Atlanta. We haven't seen a downshift in capital, like raising capital. But again, it's also that saying you only hear the dogs that bark, right? Which means if somebody doesn't tell me that they're not interested in investing, how would I know they're not interested in investing? Sure. Right? Because the amount of money we had to raise, we raised and we moved on, right? But when I talked to a lot of other people who are acquiring even more deals than I am, they're telling me, yes, raising capital is becoming extremely hard. All the institutions are out of the market right now. So raising money through them is becoming harder. So, I mean, if that's the case, raising money through retail channels is also harder.
Right. And so, okay, so Omar, I mean, I know you're like CFA, right? And you have financial background and so forth. And in comparison to other operators, you have like arguably better capacity to understand some aspects of capital.
I really hope so.
Right. So let's say, what's your view? Like, what's your view on? Do you follow like Peter Linneman, for example, on his perspective?
Yeah, I read him on and off, man. I have two kids. Sure. I wish I could read his readings more. But I have two kids, so they take up a lot of my time.
Okay, no, I understand. You're busy, obviously, like with your deals and so forth. But like, do you believe, like, for instance, like one perspective, he had a recent listen to his very recent webinar on the Walker with Willie Walker, Okay. So he had one of the discussions there he had was actually interest rates increasing is not necessarily a bad thing. It kind of leads to better redistribution of capital, if you will, and sort of, kind of like potentially higher economic output as a whole. So, so he's
I'm not saying it's bad for the country. I'm just saying it's bad for us.
Real
estate.
But so far it's been balanced. I understand that like still the current interest rate spike has been on the back of inflation, which has been on the simultaneously paired with enormous rent growth, which leads to NOI growth, which sort of has led to, cap rates mostly staying where they were, and like not really moving much in spite of like the huge interest rate spike.
No, cap rates have really moved. I have to push back on that. I don't know what markets you're in.
Okay, sure.
Markets we're in, cap rates have, they haven't moved one for one, but they moved at least 125 to 150 basis points. Nobody's talking about low threes, low four cap rates, even for Class A new build assets. If you're not going in at high fours for Class A, around 5 for Class A, and not at least 556 for Class C, look, in the last 4 or 5 years, nobody was talking about 6% cap rates.
Okay, sure. But that's because rent growth pulled back. And so that's been like...
No, I can tell you this. Again, from when you look at this stuff, everybody confuses national numbers to somehow mean every single market in America, rents are going down. Look, if you're looking at markets like Dallas, Atlanta, rent growth might have slowed down a little bit. We don't see it right now in our portfolios. And I'm not talking loss to lease. I'm talking about market rent growth, just straight market rent growth, right? I'm not talking burning loss to lease. So rent growth is still there.
It's still
the problem, at least in the verticals that we are buying, in the niches that we're buying, this is all a debt market driven game right now. For instance, if we have debt markets come back up, for instance, if bridge guys, the CLO market opens up and bridge guys are at 7.5% even, you're going to start seeing a volume of deals happening, even though it's going to be negative leverage like 150 basis points. You just can't get financing. If you can't get financing, none of this other stuff matters. It's all capital flows driven, which, by the way, is another Linneman point, that most of the valuation spikes you see are not driven by fundamentals as much as we'd like to consider it. They're driven by the flow of capital into an industry.
I know,
If capital is flowing into an industry, you can have idiots making so much money, basically.
Right. And that's how he forecasts cap rates in their model. Right? That's what they use, like the flow of funds, essentially.
But
flow
of funds, that's the word he used.
Right. But so you guys, so you're in Phoenix. You're in.
No, I'm not in Phoenix. I'm in Atlanta,
Okay.
Georgia, Florida, Texas, and South Dakota.
I see. Okay, that's cool. Because I thought, oh no, you're not. Never mind. So that's my bad then. I thought I've seen you online on one of those deals, but perhaps not. Okay, so that's so perhaps in South Dakota you're seeing a totally different picture, right? Because I mean it's different cap rates, or is it still similar? I mean it's a whole different situation there.
I can tell you this at least in Sioux Falls, because our first building is coming up now, right? We're doing developments only there. The market occupancy is so tight. I mean, it's like 99. Again, I don't know what's going to happen in a year from now. But right now, market occupancy is something like 98% or 99%. That because there is no availability, you can push rents. Purely because there is no availability of product. Right? That's now. How do you classify that? I can just tell you straight up. The reason we landlords have pricing power or the ability to push pricing right now is because there is no competing product. And if you're renting and you don't want to buy a house, you can't afford a house, renting is your only option. And if there's no rental units available, well, then the landlord's in charge, basically.
And okay, so I mean, when we again, like few months ago, like getting back to that, like when we scheduled this talk, so what was when you mentioned housing affordability, presumably we're not speaking of the current mortgage affordability we're talking about.
Oh, I wish I knew about all of this thing.
Exactly.
I would have made a lot of money.
What was the specific variable you were referring to at that time?
Pricing, straight up pricing. It's because you don't have enough product and you have a lot of demand.
Inventory kind of.
Yeah, inventory is an issue. And now it's it's not the exact opposite. But if you look at the earnings report of a lot of the bigger home builders, Toll Brothers, I think what is the other guy that's in Dallas? Horton, right? D.R. Horton, right?
Okay.
They'll straight up tell you they have all this inventory coming up, right? Or inventory is already hit the market. And there's basically no buyers, basically. Or if there are buyers, they just can't afford it at that price because the bank is just not going to lend him at that price because the rates have gone up. So now it's the flip side of this equation.
Correct. So my question is, like, I was always a bit puzzled by the discussion before on like housing shortage, which really means like a ton of different things. And now, was it listings housing shortage? That was the focus earlier, that there was, there was a significant housing shortage, is a constant argument for like the market being kind of very robust, if you will. And that has kind of disappeared because now there's like an increase in listings across like southern and western markets.
No, hold on. The inventory is going up.
Okay.
But it's not like the buyers don't want to buy. The buyers that were qualifying, say, for a $500,000 home. And again, this is not a mathematical thing. I'm just giving you a number to prove a point. The buyers that were qualifying, say, for a $500,000 home at a 3% interest rate, they're qualifying for a $300,000 home at a 7% interest rate, right? So the product now, for instance, there is still the same level of historical, what do you call it, like shortage. But the people that could buy earlier, those people can't even buy, but for the exact opposite reason as before. Earlier, the issue was they had the money, there was no product. Now the issue is they have somewhat of the product. It's not a complete one for one, but they don't have the money because nobody's going to issue them loans on that money.
Yep. Okay. Agreed. And I mean, okay, so what's your, again, like, I know you mentioned like some of the short term, like increasing cap rates in some of the market and so forth, but like, and you mentioned you don't have a crystal ball, but like, what's your outlook? Like, where are you looking, guys, to invest at the moment in the same markets?
Same markets. Same markets as before. We went into the markets knowing that, look, obviously there's some bad times are going to happen whenever. I mean, we're young, it's going to happen sometime in the future. So we just want to be in markets where we know there's, probability-wise at least, there are secular tailwinds, basically, right? For instance, people are going to keep moving. As an example, look, even in a recession, Atlanta is still going to be more affordable than New York City, man. I don't care what's happening, right? It is still going to be a lower cost of living place. The weather is still going to be better in the winters. That's just the way it is. So a lot of the impetus is for people moving. lower cost of living, lower taxes, better weather, the potential for basically if you want to start a family and do all of that sort of stuff, right? That's all going to be there, even in a recession. So I don't think it's going to change the trajectory in places like Dallas, Orlando, Atlanta, Jacksonville. It's going to stay the same. It might slow down, but the secular trend is going to stay the same. So that's why we'll keep looking into the same markets. And the other thing also is, look, we have deals in the markets. We know all the players. They know us. So in bad times, your reputation is actually an added advantage if you have a good reputation like we do, right? Because guys actually want to do deals with you. They're like, look, I got burnt by this guy. I just want to sell a deal. Maximum, like right now, when we talk to brokers, it's gone from here's my price, send me an offer, or don't send me an offer. I don't really give a shit, right? To here's my price. But if you don't get there, just send me an offer. We'll figure it out, right? So their tone has changed, right? So when you have a good reputation, people know you can close. You can do a lot more in a lot shorter period of time, but you have to be in a couple of markets. You can't be in many markets.
Yeah, I mean that makes a lot of sense to any operator, I'm sure, right? In that way. But so my view on like affordability, because we had perhaps some of the discussion before, and that's very different in South Dakota versus like southern and western regions. So my view is like the argument for high affordability to the south and to the west is true, but it takes a kind of a little bit simplistic absolute affordability perspective. So that's my view. So it takes like an absolute affordability, another relative affordability, and running fundamental studies, which has been the discussion I brought earlier on southern and western markets, shows them not so favorable in relative affordability. So this is a discussion where they still have those very strong growth fundamentals, but that relative affordability compresses their potential to an extent past a recession. And that's what I personally see. Now, it doesn't mean they're not going to come out the strongest once they're done or like a decade into the future. They most likely will, or we may have new trends there developing and so on and so forth, because it's too far out. But the general thing that has been emerging is a decline in relative affordability in southern and western. That's very much seen in Phoenix, like using example. Sorry, keep like Scott is here on this call. I always keep hammering on Phoenix, which is it's not really my goal. I have nothing. I like Phoenix. It's just because, and so it's
I just don't know anything about Phoenix, so I can't.
Right. And I mean, so it's something to look into. It's just fundamental studies on income, population, housing supply, and deviation, like kind of deviation from those. It's just like my perspective. It's kind of here. So, but again, I don't want to get too much into that. But like my perspective is, it does put a pressure on some of the. It sort of shows how markets evolve in terms of like trends changing from one region to another, and so on and so forth. Mm-hmm. And there is a merit to that. So for instance, I can give you let's offline this, Omar. Let's offline this later. It's okay. I can give you like studies that I've done at my company that kind of show 10-year ahead performance when you purchase at different levels of relative affordability, if you will.
Yeah.
And basically they show some of the most booming markets underperform, like on a very high likelihood. And so that's my perspective, like for 10 years ahead, even if we get like a very mild recession. So it's not it's not that they will outperform in this period. I don't think so. I think they are the stronger fundamental markets. They perhaps would come out stronger afterwards, but there's a very long period in which their performance may be below even what we now view as very weak, lame markets, in the Midwest or other places.
No, we'll find out. I mean, look, that's a good point. We'll find out. But also, I think a lot of the average stats hide a lot of other like issues, for instance, like certain the top performers in a market, the good ones at least, right?
Yes.
They're going to be way above the average, right? I mean, in private markets, it's Pareto principle on steroids. Basically, the top 5-10% of the guys make like 90% of the money. Right. And the rest, everybody else fights for scraps, basically.
That's true. Yeah. So you're right. Yeah. That is correct. I mean, in private markets, you can always find deals, and you make the point of operational. You do have better operational efficiency, finding better property managers and so on. stronger markets, and this is a whole challenge. But I think it's I've been speaking to like few people on that, like how do you balance this now? And perhaps the answer is some primary markets that happen to be not overvalued. And that's kind of my answer. So it's like places even like, I don't want to mention New York, because New York is actually, just got too much rent control and too many other issues. But
hold on, but to that point, look, if you understand the regime in New York and you understand how to move around the system, that is a very big competitive advantage. That, for instance, some guy who is not from New York wants to invest in New York will never understand and will shy away from that market.
Right. Yeah, that's true. And yeah, and there are some arguments, and then there's some arguments with interest rates to some of those markets, like having like significant spike in their cap rates, because they have like all this rent control, all the rent control stuff is literally destroyed in valuation. They're having like 30-40% reduction in prices sometimes, just over the fact that there is no rent growth that can be projected that is in any way there, that neither happened in this period. So per the even it's not minimum flow of funds, but per the general discounted cash flow, valuation, like how cap rates are derived in that, it's basically NOI growth and also interest rates. And so essentially, which I know Peter Lema kind of rejects that one a little bit, but basically for that general framework, it becomes very, just cap rates there ought to expand with interest rates. So you have something that's if you have something that's not rent controlled, and if interest rates go up, cap rates, do they need to go up? No. But if you have something that is rent controlled, then sure. If interest rates go up, then cap rates, they almost absolutely need to go up, because there is no rent growth that's going to happen there that is outsized or commensurate.
Yeah. And Stefan, just in my point of view,
go
ahead. It's liquidity driven, to be very honest with you.
Okay.
If you have liquidity in the market, lots of dumb things happen. And if you don't have enough liquidity in the market, you can't even do intelligent things. So a lot of times, I think most of this is like most other niches. This is mostly driven by fund flows. Basically, that's my conclusion. One can run as much analysis on this as possible. We have literally seen it with our own eyes. As long as you have liquidity, the system keeps progressing. As soon as you take liquidity away, even intelligent trades or intelligent buys or intelligent plays, even if you see the opportunity in front of you, it's there. You still need to have some liquidity to go capitalize on that.
Yeah, exactly.
If liquidity isn't there, none of this other stuff matters. It's all academic talk, basically.
Well, right. Yeah, right. But I mean, but I mean, I've seen in real life some of those reductions in those properties in terms of price reductions and so forth. But yeah, I agree with what you're saying, and I think that's why that's why a lot of operators follow precisely that in their precise flow of funds and so forth in their decision making. And so, okay, so now in terms of, do you want to talk about how you guys discover deals? I mean, it sounds like you mentioned Atlanta, there's 4 big brokers, just having a really tight, strong reputation, tight relationships with them, and that's it, right? I mean,
I'm going to be honest with you, man. That's 90% of the work. The other stuff basically just closing the deals on time. So if you have a reputation as a difficult person, it's hard to do deals, you're always a deal killer, not a deal maker, nobody wants to do business with you, man. It's just very simple. A lot of times people have this idea in their head that it's kind of like, what is it? Some Hollywood movie, right? Where you put your fist on the table and be like, God damn it, and I need this, and you do something crazy, and I don't know, explosions happen, and then you get all the money and the girls. Yeah, it doesn't really work like that. If you have a good reputation, nobody's saying you have to be a pushover, but you're easy to work with. You'll find a way around the deal, and you'll close the deal, right? Your deal closers, that reputation takes a little while to develop. Once you have it, it pays a lot of dividends. And look, a lot of times, you've actually, for instance, we now bid on deals where we've actually seen that deal the last time it was being traded, right? Or 2 times before it was being traded, both times, right? So there is some level of history in our own records. We can go and see, okay, 2018, this got traded, 2021, this got traded. What were the financials? And we match the story. Or a lot of times we've actually toured the property, or we have notes. And, a lot of that stuff only comes with time, right? So if you have the context, you have the contacts, and you have a good reputation, honestly, that's 99. The rest of this stuff about other stuff you hear online, man, most of this stuff doesn't work. You just need to, 99% of the deal flow comes through brokers, at least in this 150 unit plus range. Okay. and you just have to have good relationships with brokers. And it's not like you have a good relationship and you offer 30 million and somebody offers 40 million and $30 million guy will get it. No. You both have to offer similar money, but whoever has a better reputation, typically they'll win out.
Sure. Right.
Nobody's going to take less money.
And I mean, what about capital raising? What's your superpower there, Coit, and capital?
I wish I had a superpower, man. Capital raising is the same, man. You reach out to your investors. You're always developing investors, reaching out to your investors, whether they're retail or institutional. You're always staying in touch. A lot of times you stay in touch with people, not when you need the money, but just generally. Think about it. Like example I give my team is, look, think about it this way. If the only time somebody reached out to you was when they needed money from you, right? Even in just, person to person, forget about like institutional versus retail. It's just a weird thing, right? You're like, God, this guy's fucking calling me again or emailing me again, right? He must need something from me, right? If it's transactional, it's going to be much harder. But look, if you're pleasant, trust me, it is so shocking that having an easy, pleasant personality, right? You're easy to get along with. Nobody's saying you have to be a pushover, but you're confident. You say what you have to say, but you're easy to deal with. You have that, and you just generally stay in touch with people, right? Hey, what's going on? Just want to check in with you. People know it's a business call, but you're not just hitting them up for money all the time, right? Yeah, 99% of your problems are solved. But look, capital is a constraint. This is why you see companies like Blackstone, KKR, Apollo, Starwood, all of these companies, even when they're in a whole load of shit, they can get away with it because they can just throw money at the problem, right? And guys who are not KKR, Blackstone, Apollo, Starwood, they can't just keep throwing money in a pit, basically, right? But capital is an issue, but you keep leveling up every year, basically, by staying in touch with people, doing what you're going to say, and just being upfront and always over communicating.
Do you think some operators are going to be, perhaps in trouble, like in the future years? Perhaps, like, are you seeing signals of that, so to say? Are you seeing some operators?
I don't know if I've seen somebody being completely in trouble, but yeah, look, even if you're in trouble, but you communicate with your investors up front, right? You're upfront with them. You tell them a few months in advance, look, this is going to be a problem. And what I don't want to do is surprise you at the last day. Yeah, nobody's going to like it, but at least you'll have a decent enough reputation left. But if you're not honest and upfront, yeah, a lot of guys are going to get in trouble. A lot of guys who are intelligent, who are in trouble, have already started having the harder conversations right now. So those are the people that even if they're in financial trouble, they have an opportunity to get out of that trouble. But people who are not over communicating, who are not staying in touch the right way with their investors, and then they get into trouble, then nobody's going to cut them any slack.
Okay. Do you guys have any questions, actually? Scott, do you want to ask something, perhaps?
I have a question.
Yeah, go ahead, Oleg.
Hi, thank you, Omar, for coming and sharing your time with us. Appreciate that. So you mentioned earlier that some of the sellers are still asking high prices, and buyers do want to buy, but financially, from lending perspective, they're not able to do that. And I see there's a kind of a stalemate. Where do you see it's going to be breaking off? Is a seller going to eventually reduce the price, or is it going to stay like that until maybe the rates can start coming down back maybe in a year or two? How do you see that being resolved?
First of all, I don't think there is like one answer to give you, like, here's a magic answer. It all depends on the case. So as an example, if a seller can survive without selling, right? As an example, because they've got term on their debt, their debt isn't maturing, they do not have partnership issues, or they've been upfront with their LPs and their LPs saying, look, don't worry about it. Yeah, you're not paying us funds, but don't sell right now, because why would you sell in a bear market, right? Yeah, and that person doesn't ever have to sell to you, right? But if a seller actually has real problems, like debt is coming due, I'm already seeing a lot of partnership issues happening with people, right? Like partners couldn't stand each other, but during the good times, they were making so much money that they're like, all right, screw this guy, but we're just making a lot of money, so I don't want to rock the boat. Well, they're already getting into these problems, or they have a liquidity issue, right? So if that's the case, the seller is going to throw in the towel. But if that's not the case, the seller is not going to throw in the towel and nothing's going to happen. So it's on a case-by-case basis as opposed to, hey, this is one solution and that's what's going to happen. And look, by the way, this works the opposite way around too. If the buyer is, excuse my language, really horny to do a deal because they've got a 1031, they've got more money than they know what to do with, and they just want to do a deal because they want to pay their bills or whatever. Well, buyers also do dumb stuff, right? It's not just the sellers that do dumb stuff. Right? Or the buyer has an opinion that, hey, this market is going to be the best performing market in America, and then the market isn't. Or they've aggressively underwritten. And by the way, aggressive underwriting has worked for 12 plus years. So a lot of those guys have never really not aggressively underwritten, or like non-aggressively underwritten. Do you understand? And it's a trick that's worked out for them for so long that they don't even know what the other side looks like.
Right. I mean, is there anything like, I don't know, I kind of went over a few questions. So anything you wanted to share with us, like with our audience today that?
Yeah, look, I mean,
particularly.
Nothing big.
So
Look, the whole point here is, look, if you're in a couple of markets, just double down on those markets, double down on your communication with your both investors as well as brokers. Again, I don't know like what size of properties you guys buy and how because every vertical is different, right? And just double down on reaching out to your investors. Look, a lot of this, contrary to what most academics, most universities, most business pros will tell you, a lot of times this straight up boils down to feelings. Trust me, if your LPs feel like you've done a good job, even though in reality you could have sucked, they are going to cut you a lot of slack. This is why people that are easy to get along with, people that are, people when you meet somebody, you're like, okay, this person is genuine, right? Or this person's authentic. People that are like that typically go ahead in life because they're given second chances. And a lot of people that are just analytical and are corely analytical, yeah, they crash and burn. They will always be small time players, right? Or they'll always be working for somebody. And and I'm not trying to like say don't be analytical, but if you're just corely analytical and you're not relationship driven, yeah, you're not going to get ahead in life. That's just the way it is.
That's true. That's absolutely true. And so we have Oleg is raising hand. So go ahead, Oleg.
Yeah, thank you. I have another question. I know that you are, let's say, in Atlanta very actively, Omar, but how do you think the submarkets of Atlanta, for example, will perform, or submarket of any big MSA, I would say, in this environment? Or, again, I understand you don't have a magic ball.
Oh, I can tell you, it's very simple, man. Like, sorry to interrupt. It's very simple. Look, it all depends on what price you bought it at. So as an example, everybody says don't buy in South Atlanta, right? Which is typically considered lower income, ghetto, blah, 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 blah. If you're buying at a 7 or 8% cap rate in South Atlanta and you're a half decent operator, right? Yeah, you'll make a shit ton of money. It doesn't matter, right? So it's just a function of price. For instance, if you're buying in the northern suburbs of Atlanta, which are relatively more affluent, right? But you're just buying it at a ridiculous price, no amount of your operations are ever going to save you. I don't care if you're a magician. I don't care if you can walk on water. So this whole submarket thing is good to understand for you to develop a knowledge of, say, hey, just the market and what's going on. It all boils down to what price you're buying it at, right? I'll give you a very good example, man. We got a deal, I think June, July in Decatur, Georgia, which is part of it's gentrified, part of it's not gentrified, right? So we were right on the border. Now, for us, what's going for us right now is our all-in basis in that deal is about 130,000 a unit, maybe 132,000 a unit. And we're like, say, mid-70s vintage. So the property that borders us was acquired. It's an early. So I think we're 74 or 75 or 73, and the property that's our neighbor is like an 81 vintage property. That property was acquired at 180,000. So it's like a $50,000 delta. Now the rents are a little higher, don't get me wrong, but at the end of the day, it's a price per pound sort of comparison, right? And there's another property less than half a mile down. It's a 71 or 72 vintage townhome product. Ours is like a garden style apartment. That's under contract right now for close to $155,000. So if you look at just comps, we are very nicely positioned. So no matter, I can tell you this, no matter what somebody tells you during the investment sales process, everybody, including your lender, is going to look at comps, rent and sales comps. And if you are the cheapest sales comp, as an example, you happen to get it, or you're on the lower side of that, yeah, you'll make a shit ton of money. Because I know people like to say commercial is different and it's all numbers driven. It's not, man. People are human. When you go to credit committee or you're going to investment committee and you need to justify your selection, invariably the question always comes up: show me the comps. And if your rents are somewhat in line, because rents are always somewhat in line, right? Unless you've got a horrible product or you're stupid, right? It all just boils down to what price you're buying it at. Right.
Okay.
So if you're buying it at a decent enough basis, none of this other stuff matters.
Thank you.
But what if, Omar, what if you are in Boise, Idaho?
I'm not in Boise, Idaho.
I know, but I'm just saying, what if an operator has got all their operations running perfectly in Boise, Idaho, and now everybody has come to know through October and already November of 2022 that Boise, Idaho is basically a bubble.
Yeah.
So what happens if you're there? Then you have to now you have to give up all your operational work and move to another market, or you still keep finding deals that are below market in that overvalued market. It's like not very.
Look, I mean, look, for us, we want to be in places where, for instance, surrounding whatever market we are, there are other reasonably sized markets. So the way I look at it from my side, it's a very crude way of looking at it, but it's like basically how deep is the buyer pool or seller pool? Like I told you, for me, look at it, it's all a liquidity play, right? If there is a deep buyer pool, I'm fine, man, because this means that there is always a greater pool out there. And that's all you really need.
How do you assess, what are your ways to assess that? Like the demand?
You just literally look how much products, how much sales have happened, as an example, in the last 12 months or 24 months, how many different buyers there are. As an example, sales could be X hundreds of millions of dollars. There's only 2 buyers. I'm making an example, right? It's kind of sucks, right? But you look at the top buyers, you look at the top sellers, and very quickly you find out, guys, none of this stuff is really that hard. Go to CoStar, pull up the top buyers, top sellers, and you'll very quickly see what are the top buyers and sellers and how much volume has traded in the market.
Yep. Sure. Blackstone, we're almost running out of time. Sorry.
Oleg has his hands raised. Oleg Shalimov.
Oleg, do you have another question?
Oh, yeah, I can ask another question, definitely. I mean,
sure.
It's more from an operational perspective. Yes. Omar, how many, I mean, again, approximately, right? How many units would the person need to have in the area to maybe shift and have his own property management company?
See, that's a good question, man. That's a good question. I just use one third-party property management firm for all my assets in the Southeast, right? So that's a very good question. I don't know the answer to that. I do know guys that have 100 units that are self-managing. I would not recommend it, right? But they seem to be okay with it. I also know guys, for instance, in Dallas and surrounding like Austin, Houston, they own assets in all these 3 markets that are owning over 10,000 units and have a third-party property manager. That, I think, is a very personal question. For me, I realized, look, for me, I'm in acquisition and growth mode. So what I need to do is partner up with a trusted third-party property manager, because I've gone through a few property managers, right? And just use them across all my deals. This way, they get a good book of business and I get good favorable terms. But
why don't
you have to kiss a lot of frogs to find them. They find the right property manager.
Why don't you create one property manager?
It's a low margin business, and when I do the math, my investors and I don't end up saving enough money, basically.
Thank you.
For us, but again, this is our math. Like I told you in the example of a couple of guys I know that have, I think, 100, 120 units. Their math says that they've obviously done the math. They're smart guys. That much I know, right? So their math says that they're fine with it.
Okay. Any last questions, guys, before we're almost at our time for today? So what is the best way to reach you, Omar? Appreciate all the great insights here bringing for us and your experience and so forth. So yeah, what is the best way for people to?
Yeah. So look, you can join my mailing list by visiting my website, boardwalkwealth.com. The form is right on the homepage. And if you join now, I'll also give you access to my hidden mobile app. And that has over 9 hours of free investing courses. That's just free. So again, just go to boardwalkwealth.com. The form is right on the homepage. Just fill it out and you'll get access to me.
Great. Okay. So thanks for all the insights. Thanks
No worries.
for joining here tonight.
Oh, thank you very much. I do appreciate everybody taking the time. And thank you, Stefan, for calling me. I
Thanks,
really
Omar.
appreciate the invite. Bye for now.
Have a good night.
Thank you, Omar. Thank you, Stefan.
Thanks for it.